Today's video is sponsored by Figure Markets, the largest non-bank mortgage lender in the US with over 15 billion unlocked on their lending platform. They've just lowered rates on their Bitcoin and ETH-backed loans even more to 8.91%, which is 9.999% APR, improving their already industry-low fixed-rate 50% LTV loans. They keep building as well, having also just launched decentralized MPC custody, the only place to get that amongst the major loan providers, and removed interest deferral fees entirely. What is MPC decentralized custody, you might ask? Well, it's a Bitcoin or ETH on-chain wallet with multiple key shards to protect you from a single entity custody failure. You can always see your crypto ownership in a segregated wallet and verify your collateral hasn't moved. Whether you're funding a major purchase, like a down payment on a home, investing in new opportunities, or even buying more Bitcoin, Figure makes it straightforward and transparent. Visit their app or click my link below to take out a Bitcoin-backed loan with Figure today.
Today's video is sponsored by VeChain, the leading Layer 1 designed for real-world adoption. Live since the 1st of July, Stargate is VeChain's new VET staking platform, built around their updated tokenomic model, which forms part of the Renaissance upgrade. Stargate reduces barriers to entry, improves yield for all participants, and provides a user-friendly staking experience. Simply stake your VET, mint a Delegator NFT, and collect VTHO rewards every 7 days. Base rewards can be claimed anytime, and it only takes 10,000 VET to get started. Right now, there's a 5.48 billion VTHO early bonus pool being distributed every week to stakers through to December. That's about $10 million available for the rest of 2025. And with yields reaching up to 9% APY, the earlier you stake, the more you stand to earn. This is a limited window and the countdown is on. The best time to stake was yesterday, the second best time is today. Put your VET to work to stake, delegate, and earn on Stargate. Visit stargate.vchain.org today or see links in the description for more information.
More people are paying attention to crypto right now than ever before, so it's important to get your information from the sources you trust. That's why I want to give a big thanks to Bitwise for sponsoring today's episode. Bitwise manages over $10 billion across more than 30 crypto strategies, and they've been doing this since 2017. But here's what really sets them apart. They give back too. Bitwise actually donates part of the profits from its Bitcoin and Ethereum investments to open source developers, the people building and maintaining the networks that we rely on. So when you work with Bitwise, you're not just getting professional crypto exposure, you're helping fund the future of crypto itself. Check them out at bitwiseinvestments.com or email james@bitwiseinvestments.com and tell them Raoul sent you. Thanks. Join me, Raoul Pal, as I go on a journey of discovery through the macro, crypto, and exponential age landscapes. In The Journeyman, I talk to the smartest people in the world so we can all become smarter together. Hey everyone, welcome to the Everything Code Masterclass. What we're trying to do here is lay out our framework, of which there's really 35 years of my work in this, and Julien and I have been working together on this for the last few years. We think it's the most important work in the space of understanding why the world is like it is today, where we're going, what drives it, and what the opportunity set is. I know a lot of people watch us and see our tweets on X, and they don't really understand the full framework. And what we want to try and give you is the full understanding of why things are happening and how you can unfuck your future. So look, it's a really important hour. If you do get the chance on the Real Vision platform, which is free to join, realvision.com/join, you can also get the AI summaries and the transcript and the deck. So if you're not a Real Vision member, or you're watching this on X and you are a Real Vision member, or you're watching it on YouTube, go across to Real Vision at some point and you can get all of that stuff because it's really, really important. Also, for Real Vision members, we will be having an AMA directly after this where we'll answer questions to try and help you. And again, if you're not a member, you'll find a lot of information from people asking us questions. Anyway, there's a lot to get through here. So you guys need to grab yourself a drink or a coffee and focus because we're going to try and lay out the full scope of where our world is. After this presentation, there's actually another section, which is the economic singularity, is what happens after this. We'll touch on it at the end, but that'll be for a different session for a different day. Anyway, let me start sharing my screen and Julien and I will go through this. It's going to take at least an hour to go through, so bear with us, but hopefully we'll add as much value as possible. We wanted to help as many people in this journey as possible, and we think this framework will give you what you need to navigate these times. So this work comes from Global Macro Investor. Global Macro Investor is the research service I started 20 years ago when I left managing a hedge fund. Over time, I've always used the business cycle framework, but we've developed these secular theses and all of this tied together to come into this. What's been an absolute unbelievable thing is GMI is provably the best performing research service in the world because we've had a track record that's been recorded for 20 years. Long may that continue. We've had our up years. We've also had a few down years too. But anyway, a framework like this has kept us on the straight and narrow. So let's kick off. The key thing, I've been an investor for a long time, as has Julien, and we've run diversified portfolios. That's what we've been taught to run. We now believe that diversification is dead and the best thing is hyper concentration, which goes against what many, many people will tell you, but we'll explain why. And it all comes down to the biggest macro variable of all time, the most important. And I'll explain why this has happened. But what the issue is here is the global governments and central banks are increasing liquidity to manage debt at 8% a year. 8% a year is actually the devaluation of fiat currency that you don't see. It's kind of hidden, and we'll come into how it's hidden later. But this 8% is your hurdle rate to unfucking your future, plus you need to add inflation. Yes, it's in addition to this because inflation is not the same as debasement. So you've got an 11% hurdle rate on any investment that you have. And once you understand this, it changes what you do with your money. Because don't forget, an asset that you buy is future deferred consumption. Some point in the future, you want to release that. And because you've locked money up for an extended period of time, you expect to be rewarded above what is happening to debasement or inflation. That is the whole point of investing. Now, what is happening is most things aren't doing that. We'll come into that. So anyway, just remember this, 11%. If your investments are not hitting 11%, you are getting poorer. Okay, the everything code. It all starts with this, the magic formula. The magic formula is how you think of trend rate of GDP. It's actually driven by population growth, productivity growth, and debt growth. Those are the three key factors that drive GDP over time, and it's consistent everywhere in the world. So let's start looking at these. Trend rate of GDP has been falling over time since the 1950s and is now around 2%. Okay, so why is that? Well, the working age population has also been falling. So the working age population means that it drives less economic activity. So the trend rate of growth there has been falling too. Also, productivity has been falling over time, which is extraordinary considering the technology revolution that we've had. It has not driven productivity as much as it could have done. Yes, the measurements aren't great, but also it's a factor because of an aging population, and we'll show that shortly. Debt growth. Well, debt growth appears to have peaked back in, let's say, 2009. We had the pandemic spike, but really it has been trending higher over time, and the structure of debt has changed over time. You see, private debt, the private sector's been deleveraging. It's now down to about 100% of GDP. Total debt is still about 340% of GDP. When we get to private debts, it's about 120% of GDP and has been falling, which is good. But total debt has offset it, the public debt. The government has actually taken on the debts as the private sector's delevered, because it's trying not to let the deleveraging slow down GDP any further. It has increased debt. Okay, so that's how the three dynamics play out. But let's look at the most important one of all, demographics. Demographics is the basis. When I first started GMI, the first article I ever wrote was Debt, Demographics, and Deflation. And that has been my framework ever since. So let's understand demographics. The US birth rate per 1,000 people has been collapsing over time. It is more pronounced in other nations. It's definitely more pronounced in Europe, China, Japan. So the Western world has basically the same issue, which is the growth of population, which drives GDP, has been falling. And that means that we can forecast into the future because we know when people become labor force participation rate, or they become part of the labor force. Now, for some reason, it's a 16-year lead. Maybe you could shovel it and make it 18-year lead. But really what we find is that demographics are destiny. They forecast where the labor force participation rate is. The labor force participation rate is the key thing for economic activity. So what we've got ahead of us is a trend rate of labor force participation rate declining. And what this chart shows, this is like the most important chart of all of macro, and I've never seen it produced anywhere else ever, because I don't think people understand it. This is the chart of the labor force participation rate versus government percent of GDP inverted. So what it shows is trend rate of GDP is basically offsetting the labor force participation rate fall as the population ages out. That is why we have a debt problem. That is why government spending is so hard to manage. It's because we have this aging population. That is the key to everything, and it's only going to get worse because of this. So this suggests out into the future, debt keeps going up. Now, the economic singularity will change this at some point, but we've still got this collapse in the labor force participation rate to deal with into 2030. And that's going to drive massive increases in debt to GDP. You see, these are in perfect mega trends. The labor force participation rate is in a beautiful log regression channel, and we should just move towards the bottom of the channel and beyond in the coming years. And the reverse of that is the government debt percentage of GDP. You can see them pretty clearly, the trend. Now, the next thing that we found that nobody else has found is that Fed net liquidity, which is the use of the TGA, the balance sheet, and the reverse repo, has been the main mechanism for financing the debt. So they're joint at the hip. And so what they're doing is using liquidity to finance debt. If we do this on a globalized level, it's actually global total liquidity that is the real answer to all of this. But that you show how close that correlation is. Yes, the axes are different log scales, etc. But honestly, don't mid-curve it. This is the key thing. They're using the balance sheet plus any monetary tools possible, including the banking system, to pay for the interest on the debt. So you can see total global liquidity. They've started using the banking system as part of this. So that's why we've started switching our key measure to total liquidity, not Fed net liquidity, because it includes M2 and other measures. And you see what's happening there is it is starting to rise, as is the debt to GDP again. Now, what's interesting is when we look at the interest payments, you can see that it's the liquidity that pays the interest payments. The interest payments, because interest rates are above trend rate of GDP, that needs to get monetized because there's not enough economic activity. If the trend rate of the economy is, let's say, 2% and rates are at, let's say, 4%, well, that's double the amount of economic growth to pay the interest. We don't have it. The government's 100%, 120% in debt, and the private sector's the same. So there's just not enough economic activity to pay the interest on the debts. So this is why they debase currency. It's the story as old as the hills, but it is incredibly important to understand. Try not to mid-curve this and overanalyze this, because this is what is going on. Why did it happen, and why is it happening? As I said, it's not the first time it's happened. It's actually happened in the 1950s, and it's happened in the past too. But to understand it all, you'll understand that since 2008, everything became ultra cyclical. Before then, we had a business cycle that shifted a lot. It wasn't as clear. There was much more diversification in investments. But since 2008, everyone's like, oh my God, everything is a bubble all the time. And it's all driven by this one thing: the servicing of the debt. You see, back in 2009, well, 8, 9, everybody, every major government around the world gave themselves a debt jubilee. They paid zero interest on any debt, and most of the private sector got to zero interest as well. That allowed everybody to restructure debts. The private sector has been paying it off. The government has been increasing to offset that. But what they've done is they've created a 4-year cycle, or they had created a 4-year cycle. We'll come on to the shift in that cycle based on the debt refinancing cycle. So it's about a 3 to 5 year sector is where they've been operating at. And every 4 years, they've been basically refinancing that debt by printing money. And that happens over a 3-year period. And then there's usually a period where they withdraw money from the system before they start again. But each time it keeps going up. And that creates these weird cycles. So Bitcoin, some people thought it was the halving cycle. It's not. It's the debt refi cycle, because it happens in all assets, the NASDAQ, commodities, everything. And it's driven by this like spring, summer, fall, winter. And they're all corresponding to how much money they're printing at any one period of time. Winter's when they're not printing money, but the others are when they are. And so those are these economic seasons that we talk about. So recently we noticed that, hey, the ISM, and you've heard Julien and I not struggling, but trying to understand, okay, what's changed in our framework? Our job is to understand and double test our framework at all points. So when something major is changing, which was the ISM not fitting the 4-year perfect sine wave, we started thinking, what's going on here? The ISM is more subdued than it has been ever. And we found out that the debt had been moved in 2021-22 because interest rates went basically back to zero. They managed to extend the curve by issuing further out, and they extended the debt maturity from 4 and a bit years to 5.4 years, creating a new longer cycle. Now, we don't know what length the next cycle is. It depends on where they refinance this entire cycle at. But right now, we know we've probably got an ISM and a business cycle that extends well into late 2026, and that will affect asset prices. So this is why markets have been acting, well, crypto markets have been more subdued than people expect. And we'll come on to that in a second as well. The other thing is interest rates. Interest rates haven't needed to yet come lower, but now we're seeing the urgency from Scott Bessent, who understands the everything code, and Steve Mirren and Trump all saying we need to get rates lower. Why? Because we've got $9 trillion of debt to roll over the next 12 months. It's this 12 months that is the key to everything. It's this 12 months where maximum money printing comes. So, okay, I've given you the big picture framework now for you to understand. And now we're going to go much deeper into it all and how it affects asset prices, the economy, how to forecast it, because this is the bulk of the work that we do. So I'll pass over to Julien.
Thanks, Raoul. Okay, let me move you over here. I'm going to share. There we go. Okay, that should be up. I believe so. So the first thing I want to talk about is forecasting asset prices and the business cycle. And to understand that, the first thing that we have to describe is or define is financial conditions. Now, financial conditions is something that we developed, which is a regression on commodity prices, the dollar, and interest rates. And what we found is that financial conditions lead liquidity, and liquidity then leads the ISM. But before we get into that sequencing, let's first, now that we've defined financial conditions, I'm going to show you a lot of charts on that as we progress through the pack. Let's define liquidity as we account for it. So this is our GMI total liquidity index in year-on-year terms. Okay, so the basic formula for GMI total liquidity is accounting for both public and private sector debt. So it's essentially global M2 and then central bank net liquidity. And when I say net liquidity, I mean it's not sufficient anymore to just be looking at the balance sheet, right? You have to take into account, if we're talking about the US, something that Raoul referred to just a minute ago, the Treasury General Account and the reverse repo. So, for example, the US calculation would be the balance sheet minus the TGA minus the reverse repo. And the reason you're subtracting those is because as they go up, it drains liquidity. For Europe, it's something like banknotes in circulation, the deposit facility, other liabilities in the current account. And the same calculation is done essentially for China, Japan, the UK, and the others. Okay. And then we put that all together and it gives us this index. Now, why does this matter from a business cycle perspective? Well, liquidity is leading. Okay. So liquidity actually moves around 6 months ahead of the ISM. Now, I'm going to explain this kind of domino sequence in a chart in a second, but just remember for the time being that liquidity moves around 6 months ahead of the ISM. And this suggests that the ISM should now finally begin to accelerate. But what I just said before was we actually have a lead on liquidity because our financial conditions index leads by 3 months. Okay. And this is what that phasing looks like, right? GMI financial conditions index leads the ISM by 9 months, liquidity leads the ISM by 6, and therefore financial conditions lead total liquidity by 3. And what you end up with is what we refer to as the everything code dominoes. And what's really important just initially, if we talk about the green bar, is, and this is something Raoul and I have talked about a lot about in the past, is it's our job to live in the future, right? So we live approximately 9 months in the future versus current ISM numbers to try and then pick up on cyclical recoveries in asset prices, especially things like equities and crypto, because they tend to operate in advance to more coincident and lagging economic data. So here what you can see is financial conditions are advanced by 9. Gold is obviously the inverse of financial conditions, which is primarily a function of the dollar. Then that leads liquidity. So now here it's just global M2, but I could have very well put GMI total
also,
liquidity.
Julian, a point, just to add a point here, is that gold only recently has started mirroring financial conditions in the last few years.
True.
It actually used to be like real rates and other factors. So it has shifted around, and right now it's squarely in the financial conditions, which is why it leads. And we'll come on to that in a bit.
Yeah, or as coincident with financial conditions, but leads, as you say, everything else.
Exactly.
And then at T equals 0, that's the ISM, that's earnings, that's things like equities. It's also things like commodities and altcoins. We'll talk about that in just a second. But then what's really important to keep in mind is, and we're going to go through the business cycle dominoes, which is basically looking at the T equals 0 at ISM and backward looking. So looking at the yellow bar now in just a second. So the lagging economic data, CPI, GDP, unemployment, shelter inflation, wages, it all follows with a long lag time versus the business cycle, which means you can essentially ignore it. But this is where central banks operate. Now, I'll talk about that. Don't worry. But before we do that, there's this sequence, because it's a business cycle and the business cycle drives inflation and not the other way around. There's also a sequence of what I've referred to as inflation dominoes. And the way to think about this is early in the cycle, commodity prices start to rise. Okay, so that's early cycle inflation. Mid to early cycle as well, inflation is when goods prices start to rise. We'll talk about that as well, and I'll define that. Then late in the cycle, you have services inflation, which starts to rise, which is primarily a function of unit wage costs. And so there's this sequence in which inflation subcomponents, if we're talking about CPI, start to rise. And it works like this. So first, here's our financial conditions index, once again, versus commodity prices. We had been saying that the year-on-year change in commodity prices would start to rise, for some time now, and that's currently happening and should accelerate from here on the basis that growth is starting to improve. And I'll show you a number of charts on this. But then because commodity prices are rising, right, that means that good prices have started to rise as well, okay? And this should continue. Now, when I'm talking about core goods prices, I'm really talking about things like furniture, appliances, clothing. So it would make sense if you think about it that commodity prices would lead, right? Because if you're buying a new couch, right, and that's got wood in it, and all of a sudden, lumber prices are rising, then all of a sudden, eventually, later on down the line, that will translate into higher furniture prices or higher couch prices, okay? So that's now trending higher, and this is 19% of total headline CPI number. And then also, fertilizer prices are rising and lead food prices by around 8 months, okay? So now we're looking at a situation where approximately 33% of CPI, if we lump core goods in there, is rising and projected to rise further. But the offset, and something, Raoul and I have talked extensively about in the past, is that the current offset here is shelter, okay? And here, if you look at the Case-Shiller home price index, it's advanced by 17 months. So we're expecting this to continue to decline, and this is 35% of total CPI. So there's this tug of war dynamic between early cycle inflation and lagging cycle inflation, which is currently keeping CPI muted and should do for a while longer.
Okay, and also just to bear in mind that as interest rates come down, you always notice people say, well, the Fed is lagging because they look at these lagging things, and Julien will talk about that. But really, what happens here is as mortgage rates come down, the owner equivalent rents and the shelter part actually starts deflating.
Yeah.
Because rents often come down. And so how it's calculated means that this important part continues to deflate much longer than the rest, because that is why the Fed is always cutting rates in the business cycle rising, because this part of the CPI is always still falling.
And to that point, it's largely because they're so focused on core and not headline, and this is the biggest subcomponent of core inflation, okay? But at the same time, on the basis that financial conditions have eased as much as they have since the second half of 2022, the second derivative of CPI, now this is the actual change of the year-on-year change, has just turned positive for the first thing, or for the first time since August, I think, of 2022, but it's hard to see with that 5-year gap. But essentially, it's just turned positive for a first time in a long time. That's the point. And now what this suggests is that because financial conditions are advanced by 12 months, is that this should continue. So the balance of probabilities now is, at least as I see it, is inflation is rising from here and not falling, but there's this tug of war dynamic, which means that because these two, shelter and core goods and food and energy prices, are sort of competing with each other, it's not going to go up in a straight line. It's kind of going to be down 1 month, maybe up another, and then eventually it'll start to rise as this accelerates. But I think the best outcome is a slow and controlled sort of rise in inflation, because commodity prices are rising, because goods prices are rising. Again, that's a function of a business cycle, right?
And also the Fed always come at the final stages of this. So
that's right.
We've still got the cutting cycle to come.
That's right.
The raising cycle comes when the business cycle is peaking. That's when that will happen. So there's nothing to fear from the Fed about, oh my God, do they cut less? Maybe, maybe not. We don't think so. But remember, that whole game is later, when you're looking for the cycle top, not when we're just pulling off the cycle lows.
Yeah, and the other thing to take into account also, Raoul, to that point, is the Fed's recently clearly stated that the labor market was the top priority, right?
Yeah.
And so I'll talk about that in a second. But again, what we're talking about here is early cycle inflation. The Fed, and a more hawkish stance from the Fed, comes much later with inflation breadth. So the number of subcomponents which are rising in year-on-year terms is accelerating, and we're just nowhere near that. So this keeps the Fed engaged, no problem, and it'll definitely keep the Fed engaged so long as labor market weakness persists, which is what I'm going to talk about in a second. The other thing to keep in mind is that if we're looking at core PCE, this is the Fed median high and low estimates from the September FOMC meeting. They've given themselves a very wide range to operate in, as you can tell, and these numbers have actually shifted up. So even, if we're talking about the median estimate of 3.1, I think we get core PCE numbers tomorrow or the next day, but it's just they've given themselves scope to fulfill their mandate. And also, Raoul and I have been talking about a rise in unemployment since basically the start of this year. That's happened, and here again, the unemployment rate is within the Fed's range, right? So this gives them the green light to cut, and our lead indicators continue to suggest that unemployment should tick a little bit higher. And I'm going to explain the business cycle dominoes to you in a second, which will make this all very clear to you. But on a more kind of forward-looking basis, what's important to understand is that people are talking about rising unemployment being a late cycle dynamic, but the reality is that unemployment breadth, if we're talking about the number of US states with rising unemployment in year-on-year terms, peaked over a year ago. Okay, it peaked in June of last year at 92%, and we're currently at 48%. And yes, 48% is still elevated relative to history, but if we're talking purely like in quantitative terms, the fact that it's the direction of travel that matters here, it's nothing else. And so this rises into recession, it doesn't fall. And then if we look at overtime hours, so this is a composite of the most cyclical parts of the US economy. Recession has come when this index is trending lower, clearly, and moving towards, let's call it -2 standard deviations. And we're just nowhere near that. We're going the opposite direction. And if anything, looking at the August labor market report, it moved higher again. And then when we now composite this, so overtime hours with things like temporary help services and some other indicators, and plot that versus the ISM, which Raoul and I have talked about in the past as kind of our go-to business cycle proxy, you can see that it's a great chart. It also shows more what's going on underneath the surface and more consistent with an economy that's early cycle moving towards mid than anything else. And the reason that this works, so I'm just going to explain this, is why do I focus on overtime hours as opposed to unemployment, is because full-time hires are expensive, right? Benefits, pensions, overhead. So before employers commit to permanent staff, businesses typically lean on things like overtime hours or temporary help to ramp up, let's say, how can I say that, production or growth or scale without locking in long-term payrolls. So you're like, okay, so the forward-looking elements of employment have already turned, but the unemployment rate's still going higher. How do you make sense of that? Well, it's this. So here we are with the business cycle dominoes, and now we're more focused. We're GMI Financial Conditions Index is where Raoul and myself live, or we try and live. It's our job to live in the future, to try and forecast everything else. But now we're looking back more at T=0, looking at things like, as you can see, overtime hours, much more coincident with the ISM versus things like unemployment, which lag in rate of change terms, the ISM, by 6 months, cyclical jobs growth and earnings at around 5 months, industrial production and things like that at 3 months, GDP at 3 months, durable goods, capital goods, you get the point. And then at the end of that is core inflation, essentially driven by core services and wages. And then you see that pink bar, that's central banks, right? So this is where central banks tend to operate, and why we're essentially well over 12 months in advance central banks. So as long their mandate is unemployment and inflation, and those things are extremely lagging. And so to Raoul's point, and we've said this across multiple cycles, the Fed and major central banks are almost always late to cut, and they're always late to hike. Okay, but this chart illustrates very well, this is the Bank of England, a situation where inflation is rising, okay, early cycle inflation. So here, if you look at CPI, it's up around 2.1% off the September 2024 lows. But even so, right? They've cut by 125 basis points or 5 rate cuts. So the point here, once again, is that we're still going to get rate cuts because if the ISM moves higher or the durable goods report that we saw today ticks higher, which then there again is a bit lagging versus the ISM, that's just not the kind of data that they're focused on. Their mandate is unemployment and inflation. And so long as that continues to tick higher, which our lead indicators suggest should do, that keeps them engaged. And even then, because inflation breath is still subdued, they still have the green light to bring rates lower. Anything to add, Raoul? So far, so good?
No, all good.
Cool. Let's go to liquidity. So, we've done a lot of work on this over the years. And just, visually, if I plot this versus the NASDAQ, you can clearly see that these two lines are correlated. At times they diverge, but over the long term, since I think this starts at 2009, it's been an extremely, extremely important driver of tech stocks, okay? And the same is true of Bitcoin. But in order to really appreciate the correlation, right, what you actually have to do is put it into a scatter chart. And what you can see here is that liquidity, our total liquidity composite, explains around 96% of the variability in tech stocks and around 90% of the variability in Bitcoin. So the point here is that, yes, other things matter. Geopolitical risks at times matter. Fears at times matter. But overall, most of this is noise if we're talking about an investment time horizon of 6 to 12 months.
I think the way I try and put this is it is the single most dominant macro variable we've ever had.
Correct.
This is what the Everything Code is about. It is so dominant that only 3% of the NASDAQ variability is based on other factors. Now, the NASDAQ and crypto are both in secular uptrends built by network adoption models, but 8% of that is entirely just the debasement. The rest, the excess returns on that, is the network adoption model. But this factor is so dominant and so important that it's all that really matters. And that's why Julien and I keep saying everything else is noise.
Yep. So we'll keep going. And here's just another way of kind of visualizing that data, right? Here's our GMI total liquidity index again versus Bitcoin. You can see when it breaks out and moves higher, this is typically a good situation for risk assets, Bitcoin included. Obviously, the exception was COVID back in 2020, which I highlighted very clearly. But the point is this index is still rising. And then when we talk about global M2, and Raoul had discussed this on drinks yesterday, yes, there's been a gap that's opened up, and that's pretty evident here. But I think, again, he covered this yesterday, but so I won't touch on it too long. But essentially, this divergence started opening up in July of this year, right? So that's when the divergence started building. But what we also know, if we look at the 16th of July, that was also when the Treasury General account started to rise. And the Treasury General account is essentially the Treasury's checking account at the Fed. So all federal receipts, be it taxes and payments like Social Security and defense, they all go through this, okay?
So when they increase the Treasury General account back up to the $800 billion level, what they're actually doing is taking liquidity from the system because it's now stuck in their account and not
Correct.
going around the system. So this increase, it's always the rate of change that matters. This rate of change matters because it was $500 billion. 2023, we saw a large rise in the Treasury General account. And guess what? Crypto markets were sideways to soggy as they are today when this happens. But we're very near the peak, and Julien will come on to that in a sec. But it's a very crucial thing what happened because it was a big withdrawal of liquidity that happened fast. And crypto is the furthest out on the risk curve. So it's the marginal effect hits crypto more than anything else.
Yeah. And the TGA is recorded as a liability on the Fed's balance sheet. So as Raoul says, when it rises, it drains. When it falls, it's actually adding liquidity. And the way, I think part of the way to explain this divergence is if we just take into account that Bitcoin's market cap is around 2.2 trillion. This is a $500 billion drain. And we just assume, just for a second, hypothetically, that all 500 billion of this would flow into Bitcoin. Okay, that means that Bitcoin prices would be around 23% higher, right? If this TGA rebuild never happened. And so that would put Bitcoin, if we're looking at prices today, we're at around 111,000, 140,000. Now, again, it's unreasonable to assume all this liquidity would go there, but I'm just saying, I think if we take this into account, this explains partially
It
this
also
divergence.
explains why the year-on-year rate of change of global total liquidity
Yes,
we
has
measure
ticked down a little bit.
It's ticked down because it's the US rebuilding its general account. Now,
Yeah.
again, we're not expecting M2 to be perfect. What we're saying is explaining is why it's diverging now. And it's not some other weird factors. It's the furthest out the liquidity curve and a bunch of liquidity has been withdrawn. And this is all to do with the debasement idea and how debasement flows through the system. So it's pretty consistent.
Yep. And the good news is, and I was hoping that we would already get the 9 today, is the DeMark indicators, Raoul and I have used for a long, long time. And unbelievably, they work well on economic data and macro data, liquidity data as well. And what you can see is that 9s have typically been consistent with inflection points. Now, we're supposed to get the data today, and I'm expecting it obviously to go higher, just above, let's say, well, I don't know, it could be 0.8, slightly higher, but the point is we're going to trigger a 9 reversal. And the 9 reversal is exactly what triggered the reversal back in July, right? And also at the tops back in December of last year. So this should now reverse and work lower into year end, which then will drive our liquidity composites higher, coupled with the fact that the PBOC, so the Central Bank of China, their balance sheet's already at all-time high. So that's kind of what's offset liquidity. But this is what's impacted the drain, particularly in the US, and we believe is what is currently explaining this kind of sideways chop. But the point is that's all about to change. Okay. Now, the next section I want to talk about is Bitcoin is a macro asset. Now, when Raoul and I first started working together, we were looking at this chart, and this is basically Bitcoin within a log regression channel. And the way to think about it is, the red line could be considered fair value. The gray lines +1, -1 standard deviations, which is what they are. And then the green lines are +2, -2
Just
standard
to add
deviations.
to that, these log regression channels work spectacularly well for these network adoption model assets like Bitcoin, NASDAQ, Google, Microsoft, Facebook, the whole lot of them all have the same kind of channel, and it works really well for, even overbought, oversold levels.
Yeah, and we'll talk actually more about that later. But staring at this, I was like, okay, I being a multi-asset fund manager before, I've invested in EM equities. I understood small cap versus large cap, high yield bonds, commodities, FX, right? But in order for me to make sense of Bitcoin within a macro framework, I had to make sense of it as an input to the business cycle. And we were looking at this and we were like, well, this actually kind of looks like a business cycle, which is just in a logarithmic trend higher based on network adoption, which we'll talk about in a second. So when I detrended this and put it versus the ISM, you get this. And it's like, oh, and this was a big aha moment for me because, up until basically we started working together, the only thing I was hearing about Bitcoin was it's some schizophrenic asset class. It doesn't bear any resemblance to the real economy. It's not governed by the same economic fundamentals as an equity risk premium or a credit spread or what have you. But actually, no, it's a macro asset and it works in the business cycle. And the larger thing at play here is it's also a network value asset, which I'll talk about. Okay. So, but here's the point. Bitcoin is the ISM. Okay. The year-on-year rate of change of equities is the ISM. Small cap equities is the ISM. Cyclicals versus defensives. Here we're talking about things like consumer discretionary stocks, industrials, materials versus things like consumer staples and utilities, a function of the business cycle. Crude oil prices, the business cycle, right? Industrial metals, the business cycle. Emerging market equities, clearly on the basis that the dollar has weakened this year, is now pricing in a big recovery in the ISM, right? The business cycle. And here's just another way of looking at that, right? Typically, the big moves in crypto tend to occur when the ISM crosses above 50 and moves into its late cycle peak, call that around 60. Okay, so you can see that. And this is also why As the business cycle accelerates, ETH outperforms BTC because block space usage is a function of economic activity. So as economic activity goes up, demand for block space increases, right? As more people are come in to use it. And then this is just a great chart. This is the first time we're showing it. It'll obviously be copied. But it also explains, as it explains ETH BTC, it also explains Bitcoin dominance entirely, right? So much like you would go from, as the business cycle accelerates, you would go from growth to value, right? Perhaps, or large cap into small cap equities, or investment grade bonds into high yield bonds, or cyclicals into defensives into cyclicals. As the business cycle accelerates, confidence improves, as Main Street does better, earnings rise, and this increases risk appetite. So as per my previous example, if we just take small cap over large cap equities, investors begin to reach further out what we call, the crypto risk curve into smaller cap tokens and earlier stage products. And the opposite is also true. So if the ISM is in a situation where it's trending towards 60, Bitcoin dominance will fall.
It also explains why there is this phasing of the alt season that people don't yet understand. So people think, oh, the moment Bitcoin dominance drops, all my bag of shit alts are all going to rally. It doesn't work that way. It always goes into the next safest asset, which is ETH. We've had some new cycle plays, and we had the recovery of Solana, and then we've had Sui have been some of the dominant ones, Hyperliquid, a few others. But really what happens is it goes from Bitcoin to ETH into the other layer ones and larger projects. And then eventually, as Bitcoin dominance collapses and the ISM goes up, only then do you get the rest of it. It all lies ahead, and you're all getting frustrated, and you're getting frustrated because A, you've probably got the wrong allocation for this point in the cycle, or B, the ISM has been lower for longer, which is why we've not seen this yet. And that's why both Julien and I keep saying you've got to have patience. You only get one piece of economic data a month. This thing is not real time, but you're trading your shitcoin portfolio in real time. That's not how it works. So that's to bear in mind.
But and so what's important here is that if we look at our leads, right? So here, our GMI interest rate model, which is advanced by 6 months, ISM's heading higher. Financial conditions index, right? Which is the index I talked about earlier, right? A regression on commodity prices, interest rates, and the dollar higher, okay? On the basis that central banks, over 90% of central banks are cutting rates, right? Advanced by 9 months, right? Higher. And then when we lump, all of these together, we're in a situation where lead indicators of growth momentum are rising. And once again, yes, I'm the person who names these, and they're just the most ridiculous names ever. Whatever, the GMI, central bank policy liquidity, and leading indicators of growth momentum index. But the point is that you can see very clearly over the next 9 months, we're in a situation where the ISM, or the probability of the ISM rising, is a lot higher than falling, okay? Now,
this is why I don't get the recession talk. People are looking at present day, and the key, even Stan Druckenmiller talks about this, the key to macro, in fact, the key to all investing is to live in the future. So there is no evidence at all of a recession. All the evidence points to economic expansion. And people who are calling for recessions don't understand the business cycle and don't do the work on the business cycle. They just look around them today and say, well, things are sluggish. Look at unemployment. We see this all the time, and everybody is wrong with this. This is the framework we've used for literally, I've used 25 years of investing, 20 years of GMI. It's this stuff that matters.
I think the mistake, before we continue, that's happening here is, if we just reference a data point I've seen floating around recently, is heavy truck sales in the US. People are showing that in nominal index terms. But by definition, a business cycle is not a nominal index, not about the level of interest rates. It's not about the level of heavy truck sales. It's not about the level of building permits. It's about the rate of change in these inputs, or these indices, or whatever. And so when you take the year-on-year rate of change of heavy truck sales and you plot it versus the ISM, it lags the ISM by 5 months. Job openings in year-on-year terms are rising, right? But they also lag the ISM by a couple of months, right? So when people are showing new home sales in just nominal index terms without taking the year-on-year rate of change, by definition, they're not taking into account the business cycle, right? The acceleration and deceleration of data over time. So I think that's part of the confusion. Whereas here, the ISM is a diffusion index, which is why it works with all the year-on-year comps. So it's really about the year-on-year rate of change because this is what markets price off of. If the economy was slowing, risk assets would not be repricing an ISM that is rising. EM equities would not be rising, right? None of this would be happening is I think the point. The next thing, as I said, Bitcoin is a macro asset, but something Raoul's talked about before is it's also a network value asset. Now, Raoul's going to go into the Metcalfe law stuff a little bit more later, but so if we think about this, Metcalfe's law is time, right? That's adoption, but the business cycle is the rate of adoption across the business cycle. So what I mean by that is as time goes on, right, as time passes, because Bitcoin is a network value asset and it's trading within a long regression channel, the more time extends, the higher the price targets become. So here, if we're just looking into year end, let's say Bitcoin does nothing from here and just stays between the fair value, call it, and the -1 standard deviation oversold level, we basically will approach, let's say, 210,000, right? If we get to 1 standard deviation, it's 412,000. If we get to 2 standard deviations oversold, right, which has happened every other cycle in the past, we're looking at something, and I admit that green's a little bit hard to read. It's like 800,000, 805,000. But here's the thing, because we detrend Bitcoin and we know it's a function of the business cycle, now all of a sudden you can loosely infer levels of the ISM that would correspond with certain price targets within Bitcoin, right? So for Bitcoin to reach 210,000, as I had referenced before, that's equivalent to an ISM of 52, something like a 1 + 1 standard deviation, 57.6, that would be Bitcoin around 400,000. And then an ISM of, again, hard to see with the green, 63.3 would be Bitcoin at around 800,000, right? So you see, so as time goes on, the prices move higher. And because the ISM is confidence, earnings, the business cycle, everything else, then that all of a sudden accelerates the move. And where things get really interesting is here I've pushed out the targets another year to year end of 2026. And you can see just by way of this log regression channel and the passage of time, now the targets are higher. So ideally, what you need for, let's say, Bitcoin to hit $700,000 in price is you would need the business cycle to extend to year end of next year, right? And the ISM to be strong, okay? But what we know right now is already our lead indicators are suggesting the ISM will be strong. And 9 months from now, we should be in a situation where the ISM is in its mid-50s as opposed to the current level of 48.7. So in a situation where the business cycle extends into 2026, how far? We don't know yet, but already this has us into Q2 of next year. So that's that passage of time plus the strength of the cycle. If we get to that 55, you have to think about higher price targets, okay? Now, the scarring here, I believe, comes from this 2020.
The scarring. Everybody is scarred because everyone has this framework that used to be around about the halving. Then it was like, and I still get the thing about the ETH blow off top that I was expecting last time around, didn't get. I didn't understand this then. It's the work that we've done subsequently. You've always got to go and do the work when you're wrong to understand, okay, why was I wrong and what is the key factors? And people are still so scarred by this that I think it's going to fuck up people, because if we're right, the cycle extends longer. And if we're right, prices go further than expected and it will not end this year. And I know everyone says, yeah, this time is different, sure. From all of the work that we do, probabilistically speaking, it's got an extremely high probability of going well into 2026.
Right. And just to kind of visualize that scarring, if we come back to that 4-year cycle and say we're in the third year of that 4 cycle, you can see here that if we look back to 2013 and 2017, we had these really big moves. And we'll talk about the 2017 cycle in a minute. But then you look at 2021 and you're like, hey, well, what gives? Why was that a truncated cycle? Well, the answer is because in March of that year, guess what? Liquidity peaked and went down in a straight line as central banks withdrew liquidity. Okay, right now we're still just hovering around zero, right? But dipped a little bit.
And again, the key point being, even if you look at the 2018 peak, it was the peak in liquidity. Liquidity was still coming into the system. It was the rate of change that stops it, right? Again, it's hard to get your head around, because you'll still see global liquidity hitting new highs, but it's the rate of change that matters the most.
Yeah, and the other point to that is, no, I've heard certain people, well, we haven't had a business cycle, but we also really haven't had a liquidity cycle quite yet. Yes, global M2 is moving higher on the basis that the dollar is easing financial conditions, but actually, if you look at central banks, we haven't had a liquidity cycle.
And the reason being is the debt doesn't need to be rolled until now going forwards.
Rates come lower.
That's the key difference. So it doesn't have to get rolled. Rates haven't had to come down. Liquidity hasn't had to be injected in large, gigantic amounts yet, but that's all going to change.
Yeah, because the everything code happens in 2 phases. First, rates come lower, then the debt can be rolled as it can be rolled at obviously more manageable and sustainable levels when rates come lower. Okay, so liquidity peaked in March 2021, but guess what?
Although, sorry, Julien, just to bear in mind is that people think it's all about interest rates. It's not. They operate at the margin here. It's the liquidity that matters. So when we go to 2017, that strong 16, 17, the Fed were raising rates. They were shrinking the balance sheet. People have in their minds, you need quantitative easing and you need rate cuts, because that's what happened in 2021. It didn't matter, because what was happening is China and Europe were injecting vast amounts of liquidity into the system. It was total global liquidity that matters the most. So everyone needs to understand that.
Yep, good, fair point. So in March of 2021, liquidity peaked, but guess what else peaked? The business cycle. So you have the 2 most important drivers, as we've outlined here, peaked in March of that year and just went down basically in a straight line. And here's what's important is, had we been sitting together all together in Q1 of 2021, this is what we would have been looking at. We would have been looking at a situation where financial conditions were tightening. Okay, so as the red line moves lower, it means financial conditions are tightening. The ISM is at 63.8, and we were projecting a decline in the ISM over the next 9 months to go down to 53.8. We obviously know it went lower than that, but here's where we are today, and I'm going to skip back and forth because I think this is quite powerful. It's where we are today. Okay, this is where we were then, today. Okay, so the business cycle and the liquidity cycle are in a very different place today than we were back then, because on one hand, the business cycle is still, well, the ISM is still below 50, right? But directionally moving higher. Okay, and the liquidity cycle, right? REAR, GMI, total liquidity index, is moving higher. And the other point I'm just going to mention, if I skip back to this chart, what also truncated the 2020, 2021 cycle was the fact that, once again, the ISM is a diffusion index, but it behaves like a year-on-year comp, which is why all the year-on-year comps correlate versus the ISM. But what happened in COVID is in April of 2020, the ISM dropped to 41.8, which then all of a sudden meant, from a base effect perspective, that it had to go up in a straight line, right? That's how the year-on-year comps work, which then meant the ISM went up, well, in a straight line, and that truncated the cycle. Whereas here, as you can see, we're just kind of slowly moving higher, which is an ideal scenario because it actually means, I think, the business cycle extends further, as I explained a minute ago. So liquidity is higher, and at the same time, some of our top cycle indicators are just nowhere near traditional levels which would correspond with a major peak. And here's just another one. I think we must have, I don't know, mate, I like 20 of these. But the point is that we're just not there. Now, if we come back to 2017 for a minute, and we start with the dollar, basically in Q4 of last year, Raoul and I were making the case that the dollar would go higher on the basis that people would see Trump 2.0 just as they saw Trump 1.0 implementing tariffs and that being inflationary, and that would drive the dollar and bond yields higher as rate cuts got priced out. And that's exactly what happened. So here we are. Here's basically the dollar August of 2016 to January of 2018 and the dollar today. So the dollar went higher in Q4 of last year and 2016. That tightened financial conditions. Economic activity went lower for a period of time. And then Trump came out back in 2017 and said the dollar is too strong. Because why? Because he knows that the dollar slows exports, it decreases corporate profitability, and it generally just weakens growth. So Bessent, Vance, Trump, they all knew that they had to get the dollar lower. And then we said in January, had you been following along in our reports, that the dollar was basically going to go down. And it's done exactly that. And that's also meant that if we look at global M2 now versus back then, it just went up, and it's still going up. Bond yields, what I had been saying earlier in the year when rates were moving a little bit higher, was as long as rates don't trend higher, it wouldn't be a problem, and the dollar decline would offset any move in rates. And that here again, it's not a perfect correlation, but you can see rates have basically done exactly what happened back in 2017. Range bound, and actually started the year and ended the year flat back in 2017. So if anything, rates have actually come down this year. And then if we look at what happened back in Q4 of 2017, because guess what? The 12-week lead of global M2 worked back then as well. We saw a 500% move basically from mid-September to, call it, the first couple of weeks of December. And well, why? Well, first of all, global M2 was moving higher, right? And yes, there are divergences at times. We've never said it would fit perfectly. It's the direction of travel, which is important here, right? So that was moving higher. But you also have to remember that in terms of seasonality, right? So this is the average Bitcoin price move looking back since inception. It's really the next couple of months where things get really interesting, right? And over the long term, we have the best couple of months.
Generally speaking, crypto returns all come in a 6-month period. It's Jan to March, and it's October to end of the year.
Which is exactly kind of what we've felt over the last couple of years, right?
Yep,
we've seen it zone from
very seasonable.
Yeah. So anyway, there's that, and then if I overlay Bitcoin's price today versus that 2017, analog, this directionally is what we have in mind. Will it end the year at 220, 200? I don't know. What I'm trying to say, much like the global M2 chart, is the macro backdrop is very similar. Okay, rates did the same thing, the dollar did the same thing, economic data did the same thing, global M2 and liquidity did the same thing. And so I think balance of probabilities is that the next couple of months are going to be very strong. So I'm going to stop there and hand it back to Raoul.
Yeah, and also bear in mind that this is through to the end of the year. We actually think it extends into 2026, and that's going to be an important factor. And our view is Q2 almost certainly, but it could even be longer than that. We don't know. We have to assess as we go. So people say, you forecast this. What we're saying is, probabilistically speaking, with the data that we have today, it'll be this. It is extremely unlikely that it tops this year because ISM's just not there and global liquidity isn't either. And the structure of the debt cycle explains that. So hopefully we've got across that. Hopefully we've got across that recession fears are completely wrong. They're the wrong way around. People are looking at lagging stuff. That what we will see is a stronger business cycle, which will drive this. So you've seen a whole amount of depth of work that goes into this, and behind all of this, there's about another 50 indicators on each one of these points, and that's the depths that we go into a global macro investor. And those of you who are Real Vision Alpha members, you get a lot of this updated from the macro investing tool report in Real Vision Alpha. And the pro guys, you get much more of our analysis and nuanced understanding, plus the AMAs where you can actually ask us how it works and also compare it with what Andreas is doing with his team and also what Jamie's doing on the crypto side and how that all fits together.
Well, and also the trades.
And also the trade ideas, which have been
we've had
exemplary.
We've had a great year.
Andreas has killed it this year as well. Fantastic. So, and as has Jamie. So that's kind of how it works. GMI is the core of this, Global Macro Investor. It spills into the macro investing tool because we want to give this kind of knowledge to as broad a base as possible. The detailed understanding comes in Pro, not as detailed, even close as GMI. And then you get the AMAs to be able to find out, and then the trade ideas as well. Okay, so I'm going to share the chart and move forwards with our presentation. We told you it's going to take long, but there is a lot to get through. So take into account everything we know about debasement, that it is the massive macro factor, that it drives all assets, including the business cycle, that it's all related. So everything is correlated. So when you start to come that understanding, you start to think, what is the point of diversification? You start to think, actually, what I should be doing is using the most powerful macro variable we have ever had, literally in the history of macro. And it explains most of the price moves. So therefore, we trade that. And by trading that, we start looking for what is the asset you want to own? How do I make the most returns from this incredible macro opportunity? And we call this the supermassive black hole. This is why a bunch of macro guys like Julien and I in crypto, it's why we've ended up in technology stocks. It's this that is the key factor. And this is the mega trend that you need to be aware of. This mega trend, if you think about it, what is debasement? Debasement is scarce assets going optically up in price because the denominator, fiat currency, has fallen. But the issue that's affecting society globally is that wages and earnings are driven by GDP growth and not debasement. This is why inflation and debasement are two different things. So what we found is that earnings, household earnings, corporate earnings are driven by the business cycle and GDP growth. But the debasement drives the assets. Now, the debasement is at 11% a year and GDP growth is at 2% a year. So what you get is everybody getting poorer. The amount that their earnings buys of, whether it's gold, which is the nice pure way of looking at it, is less every year, or of real estate, or of anything, which is why house prices are so expensive now. It's all based on the debasement and the fact that it doesn't help your earnings, which is why we talk about unfucking your future, because you are so fucked if you don't have long duration assets like crypto or technology in your portfolio, because you're just not getting ahead. In fact, you're really hampering yourself. So we'll come on to a bit more of that in a sec, because it is the key killer point for you guys and unfucking your future. And while you feel that the world is running away from you and you can't catch up. So when we look at NASDAQ versus total liquidity, so this is the outperformance of NASDAQ versus total liquidity. We can see that it's been doing about 13.8% in excess returns. So you've been handsomely rewarded by NASDAQ. Why? Because tomorrow is going to be more digital than today. So many people are so stupidly scarred by 2000, when this has been the greatest bull market in history, is the NASDAQ, going back to 1985, 1990. And yet people still miss it because there was once a bubble that burst. But even then, returns have compounded massively over time. So that looks good. We understand technology investing. We understand the rise of these new giants. We're seeing the change from the internet world to the AI world. That's driving excess returns again. But when we think of Bitcoin, it's actually driven 94% a year excess returns over the rate of debasement. So you've got this asset that is in la la land in returns. versus anything else. It's 144% annualized returns. That's including all of the drawdowns. So all of the bullshit nonsense about Bitcoin's too volatile, it's a bubble, it's going to burst. That happens every cycle. People don't understand it's the duration of your investment that matters. If you have a long-term time horizon, those pullbacks are actually what you look forward to because you can buy more at cheaper prices. Or you can, if you want to, reduce risk from the cycle. I've done both, and I found, generally speaking, if you don't need to take lifestyle chips off, it's better to have the drawdowns and not try and time them, because I've done that too, and that's not the easiest one always. And it's also very difficult to put back in what you took out at the peak. You know, if you've taken out 100 grand at the peak and the markets are crashing, everybody hates crypto, you think everybody's going to prison, the last thing you want to do is put your 100 grand at risk back again. So you always do less, and you end up actually lowering your returns over time as opposed to adding to it. So you've got these assets that are cyclical, that have this incredible adoption rate that well in excess of the debasement of currency, which is crucial. And Bitcoin is the one. But let's first look at our asset management firm, XPAM, where we invest in a broad basket of crypto hedge funds. What we're trying to do within XPAM is capture the trend move from $4 trillion of market cap today to 100 trillion. That won't all be driven by Bitcoin. In fact, Bitcoin dominance over time will change. We're trying to capture the mega trend. That mega trend is so powerful because it's how you unfuck your future. Now, if you look at all of the assets on this table, what we've got is everything in orange here underperforms the debasement of currency. So you're actually getting poorer by owning small caps, REITs, treasuries, preferred, high yields, investment grade bonds, everything, unless you're using leverage. There's only a few. The SPY, well, really, that's in line with debasement plus inflation. So when we're looking at those, you've actually only got two asset classes: technology stocks and crypto. And within crypto, you've got these ridiculous returns where Bitcoin since 2012, we didn't go 2011, we didn't go back to 2010 or 9 because the numbers get too stupid, has annualized 130% with that 64% drawdown, 73% drawdown, and 56% drawdown. Ethereum is doing about the same, about 133%, and we expect it to outperform in this cycle as it has done in all of its cycles over time. And Solana is currently, because it's newer in its adoption model, has been outperforming Bitcoin. And then if we were to add SUI in here, which Julien and I are heavily invested in, that has outperformed Solana because it's earlier in network adoption, where you get the steeper part of the adoption curve. So really speaking, there's not many assets to own unless you want to fuck your future personally. So when you want to unfuck your future, you start to think about, okay, I've got crypto and NASDAQ. And I know a lot of you right now are all trading tech stocks because Bitcoin's been in this kind of sideways chop period. So you're all piling into tech stocks. Julien and I have tons of them in the portfolio. We love the technology trend. It's a really easy trade, has been an easy trade. But if you're honest with yourself, if you were to own one or the other, then you find that the NASDAQ has underperformed Bitcoin by 99.94%. What is the point of owning any other asset? This is the supermassive black hole of assets, which is why we personally are all in on crypto, because this is the big one. This is the greatest macro trade of all time. This is why many of the greatest macro investors of all time have moved across to crypto, because it is such a powerful trend with such powerful returns, and the cyclicality makes it also tradable. It's also the most powerful, the greatest macro trade of all time, because it's driven by network adoption. Remember, Metcalfe's law is driven by the number of users and the total value transacted on a network. Go back to Amazon, a perfect network adoption model. Metcalfe's law drives Amazon. People don't understand the valuations of Amazon back in the early days. You see, what happens is they had a number of users and they were only buying books. So the total value of transactions was low, but there was a lot of users. They started adding new products in. The value transacted on that network exploded. As they did that, the number of people using it exploded. That is what drives these incredible log charts of all the technology stocks. It also works in crypto. By the way, sorry, I forgot to mention before, we talked about this debasement versus earnings. That is why you see all these people, old school analysts, screaming about PE ratios. PE ratios are back to where they were in 2000s. Everything's going to crash. You don't understand. Earnings go with GDP growth, and price goes with debasement. P ratio always goes up in periods of debasement. That is how the world works.
Which is why valuations look expensive today, because prices are rising with debasement. Earnings are still subdued because the business cycle is subdued. So basically, all that needs to happen between now and next year is earnings need to rise to justify the valuation premium, which is already baked into equities.
But PEs will still go up.
Correct.
There's different valuation. PEs will go up, but it won't go up as fast. But it's been driven by this debasement trend. So, okay, let's go back to this chart. This chart is a killer chart, and everybody mid-curves this. This is total internet users in millions from 1992 when there was first 5 million users of the internet, and crypto users 2016 when there were 5 million. Now, we use active wallets as a proxy versus active IP addresses. Are they perfect? No. We all have lots of wallets. We all have lots of IP addresses. It is the direction and the rate of change that matters. The internet grew at 76% a year and then started flattening down to about 43% a year. That's very typical of network adoption models. Crypto has been growing at twice the speed of the internet. We will have 1 billion active wallets, and we can proxy that for active users. Yes, there's less active users. I get it. Doesn't matter. Don't get caught on mid-curving it. What it's saying is it's growing twice the speed of the internet. This is the fastest growing technology in all human history up until AI, which is dwarfing it already. But the difference between AI and crypto is you can't own crypto. You can't own AI very easily. And you couldn't own the internet. But here, you're getting a token in the infrastructure layer of the entire new internet, which is blockchain. And blockchain is not just about Bitcoin. It's not just about Ethereum. It's about all of the use cases of these various chains. We've seen the same with cloud compute, and that's split amongst tons of companies. Yes, there'll be some giants. There'll be some fast adoption. There'll be new use cases. It's all coming. And don't forget, here we're still in the speculation plus stablecoin phase. We haven't started really putting real world assets on chain. That's coming. We haven't even started putting Web 2 into Web 3. That's coming. That's a mega trend. That'll suck in the next rise, which is by 2030, we think we get to half the world's population having crypto wallets. Again, don't get stuck on the metric. What we're saying is the growth continues massively, and it will continue to massively outpace the internet. It's basically the future of the internet with different rails. It's the read, write, own rails of Web3 that will become increasingly important for things like digital identity, how AI agents interact, how the financial system operates, how the system of money operates, how collateral operates. It's all this. So this is the mega trend. This is why we're trading it. This is why it's outperforming everything. You need to understand Metcalfe's law. Okay. So we go back to this thesis at Xpan that we have that right now, crypto assets in total, all digital assets, are a $4 trillion market. Global real estate, 400 trillion. Global debt, 300 trillion. Global equities, 100 trillion, et cetera, et cetera. Gold, 20 trillion. Now, Bitcoin probably replaces gold. Okay, so we know where Bitcoin's going. But the rest of it is going to account for the other part of this equation. And that comes from this total market cap of the entire space. If we just use the same log adoption channel, which works in everything, and we've shown it, it tells you we get to 100 trillion in value by somewhere like 2032 if we just follow the fair value curve. So by 2032, 7 years from now, this entire space is $100 trillion. If we go above that one standard deviation, it gets there faster, or it gets to a higher valuation by 2032. So that is an astonishing opportunity considering we're only 4% of the way there. That's how you need to think about this. Then you need to think is, what is the structure of the crypto market going to look like? Well, Bitcoin will be the sort of percentage, let's say, that gold is of total assets. Well, total assets here is, somewhere close to, I don't know if I'm looking at it, 500, 800, call it $900 trillion, and gold is 20 trillion. So Bitcoin will be somewhat similar of the new system. So what we're seeing is the game is yet to be played in much of the component parts of this. That's including the applications layer as well. Who's building what on this? This is what's making it such an incredible thing. Okay, let's go to the banana zone. The banana zone is what Julien and I have talked about as the acceleration phase that happens as they start rolling the debts. That's what creates the parabolic. Now, everybody misunderstands this or has a short memory. We said, and I remember it clearly because I came back from Zambia on safari, came back, did a video, Julien and I, banana zone starts now. That was August, September 2024. From then on, the market ripped higher and we chose various assets. We chose SUI, Solana, and we said these are going to outperform, and they did massively. SUI put on a 5 or 6x over that period. Then we said, hey, global M2 is slowing. We're going to see a correction. This is we'll call the phase 1 correction of the banana zone. That was phase 1 correction. That finished in April. Julien and I came on and said, by the way, this correction's finished based on our work on global liquidity, and the markets are going higher, and the markets have gone higher. We said Ethereum will start to begin to outperform. Solana will come back. Exactly those things started to happen. We are now still in the early phase of phase 2. This is not a phase 2 correction. We've barely broken out. In fact, most other assets, thinking about stuff like total market cap, X, Bitcoin, and ETH, haven't yet broken. Now, think of the banana zone here. All of these previous 3 were all only one period wide, this 1 year. This one will be wider. So, which is why the market looks less parabolic at this stage. But the parabola will occur, and Julien showed you with that work earlier, and we will have a phase 2 correction later. Our general viewpoint is the phase 2 correction is either the one towards the end of the year when people think, well, Bitcoin traditionally tops here, I'm out, or it's a larger correction from March through till later in the year. It depends how long the cycle plays out. Because obviously that March onwards periods, again, if it continues to play out into the end of 2026, which is possible, not our highest priority yet, but if it does, then we'll have that period and people say it's all over. But again, it's unlikely to be over. But we don't know that yet. All I know is the next correction will be phase 2 and not the final one. And that's likely into year end. So hopefully we've given you the full framework of understanding. We've gone back to the really big picture, demographics. We've gone through to debasement of currency, why your future's fucked. And now we've gone through to how it affects everything, the business cycle, how it all comes together, where inflation fits into the picture, where unemployment fits into the picture, how you think about asset allocation, why you're concentrating your portfolio, why it's rational that you're trading crypto and tech stocks, and you should be doing that. This is the way, if you follow a framework like this, using the overall structure of this, it will really change how you do things. You won't be lost in markets. You will lengthen your time horizon. You won't be asking me, hey, is this correction over yet today? I don't care. Look at the trend. We're 4% of the way there. We're going to $100 trillion. Your job is to not fuck this up. Not fuck this up means be careful with your asset allocation. Buy the bigger proven stuff. Generally top 10, top 15 market cap. Don't use leverage because you get washed out every time there's a correction. Expect pullbacks of 20, 30%. They're normal. That's the kind of volatility you will have to suffer if you want these returns, and you have to be comfortable with them. Then you need to not get hacked, do stupid stuff online. Don't lose control of your tokens. Use a ledger device. Use a multi-sig wallet. Do the things to not lose control of your tokens. Be very careful when you're using DeFi. Don't lose control of your tokens. If you lose control of your tokens, you're out of this game, the biggest macro trade of all time. So anyway, we're going to now move across to Real Vision, where we will answer questions on all of this. Hopefully this has helped you. Please share it with everybody. We can't stress how important this is. We're not expecting to be 100% right. We are honest with ourselves. Things change, things will adapt, but we have a pretty damn good look into the future. So follow along for the ride. If you're not over in Real Vision, then you should come over there. You can ask us questions. Macro investing tool will give you the business cycle understanding and some of the secular stuff, small amount. When you get to Real Vision Pro, you'll get much more of this. And then when you get to GMI, you obviously get the whole thing and the deep discussions and the long conversations, but that's not for everybody because it's priced for institutions, family offices, and others. Anyway, I hope it helps. I'm going to go across to Real Vision now. Obviously, if you're watching YouTube, everything else, please like all of this, share it. It's important. All right. See you over in Real Vision.
Sure.
Okay. I'm going to pull up the Real Vision one now, if I can find it, and start answering questions. Okay.